7 tech stocks, known as the Magnificent Seven, were investor darlings in 2023, raking in gains of between 49% to 230%. But is it too late for new investors to jump on the Mag 7 bandwagon, and are prices too high?
Now, these stocks are not just riding the AI wave, they're actually pretty much defining the future of AI. All of these companies have specific elements of risk attached to them and idiosyncrasies attached to them as well. So when it comes to how you are to position yourself as you move forward, we have to look at, as an investor, to diversify beyond these Magnificent Seven.
In the first 5 months of this year, the Magnificent Seven, as a group, outperformed the S&P 500, doubling gains. But if you look at individual stock performances, things look quite different.
If you take out Nvidia from the Magnificent Seven, then the performance of the Magnificent Seven x Nvidia actually trails that of S&P 500 on a year-to-date basis. So when it comes to Nvidia, it has actually shown and continues to show very, very strong earnings momentum. Nvidia is pretty much like the gold standard when it comes to these GPUs or graphic processing units that basically power these AI systems.
Strong earnings and investor enthusiasm over AI are supercharging Nvidia's share price. In the first 6 months of 2024, Nvidia's shares surged over 180%. In June, the chipmaker became the world's most valuable company, with a market capitalization bigger than Microsoft and Apple in the $3 trillion club. Nvidia's market cap is also almost as large as the UK economy, the 6th richest economy in the world.
In the case of Nvidia, if you take a look at a measure which I like to look at, which is the price to free cash flow. So if you take their market cap and divide by the amount of free cash flow it generates, it gives you a multiple, right? And typically you want it somewhere between 20 to 30 times. But in the case of Nvidia, it's trading at 77 times its trading free cash flow. So you can say that's quite expensive right now, but there's a good reason for that. Today, in this fiscal year 25, which ends in January next year, Nvidia is expected to double its revenue and double its free cash flow. Investors are expecting the company to grow extremely quickly over the next 9 months.
But investing in these stocks does come with risks, and one major risk is their high valuations. The Magnificent Seven are trading at an average price-to-earnings ratio of around 44 times. That's a big premium over the S&P's average. Investors will need to ask themselves if these companies can continue to grow into their valuations in future.
I don't think we're at levels where we would say that like the 1999 tech bubble, ridiculous valuations, companies were trading at 100 times or 200 times earnings, or 10, 20 times sales, and many companies not having any earnings. These are very, very profitable companies that are seeing strong growth in earnings, who have dominant positions in their respective industries.
These companies have very strong fundamentals. They have very strong moats. They have pricing power. They have earnings that are growing at a significant momentum, and their guidance is also, very, very good as we look forward. So together, they also have very strong balance sheet and cash position, so they can afford to keep investing into the future AI potential and keep their competitive edge. So if you put all of these together, yes, I would argue that maybe the valuation is justified.
While Nvidia's shares have continued to rally, other companies in the group like Tesla are underperforming.
As much as Elon Musk wants to think as Tesla as an AI and technology company, at the moment they're still a car company, right? But the majority of its revenue is still dominated by the number of cars they sell. And because of that, they are going to have to deal with the economics of manufacturing cars, which is a really, really difficult thing to do. And the full self-driving or the services which goes on top of the car itself, right? And I think that is the area where investors are looking at.
Despite unveiling its new AI strategy, Apple's shares are also falling behind other big cap tech names.
So for the case of Apple, I think what they are doing is quite similar to what Alphabet and Microsoft is doing. They are partnering with OpenAI to implement more of this generative AI services across their different apps which they have right now.
One pain point for the Cupertino giant is slowing iPhone sales, its biggest moneymaker.
In the case of Apple, I think given the size of the company, it's going to be increasingly harder and harder for them to grow. So I can say for sure that their growth in the next 10 years is not going to be the same as the past 10 years. But for companies such as Microsoft or Alphabet or Meta or even Amazon, I think that achieving 15% growth, I think is still within their reach.
With share performance and future growth prospects so divergent across the cohort, analysts caution against putting all your money into the Magnificent Seven basket.
Obviously, if people want to get dedicated exposures to the Magnificent Seven stocks, then they can pick them individually or they can bundle them together into baskets and trade them that way as well. But so I think it comes down back to the concentration risk, right? And I wouldn't recommend anyone to go very deep into just the Magnificent Seven stocks. If you look at the broader indices, they are market cap weighted. So obviously, if these companies are dominating the market caps and representing more than 30% of the index, then by default you get overexposed to these stocks in particular. One way to reduce that concentration will be to look at equal weighted ETFs.
I think that there's a lot of volatility in these stocks, and it's important to not put all your eggs in one basket. So I think if you can buy initially a basket of stocks that are good companies, if you want to have direct stock exposure, or maybe investing in an index fund like NASDAQ or S&P 500, which is more diversified, but gives you, meaningful, good performance over the long term. And then study and get to know the companies that are in the index or in the NASDAQ or in the, the top, top market cap companies or the largest companies, which invariably will include the Magnificent Seven. And then within that, you can actually select what is the best investment for you.